Okay, well, we'll kick things off today. Thank you for joining us today for our discussion highlighting 6 markets that paint a nuanced picture of our outlook for CMBS hotel performance at this point during the pandemic. We're joined today by the authors of our recently published research, Masha Smirnova, Alex Chinook, Romir Agarwal, Nan Zhu, Zavin Torian, and Chris Steinley, as well as Dave Putro, Senior VP in our surveillance group. If anybody would like a copy of our hotel research, it's available on our website, and we'd also be happy to send it out to you if you'd like to request it. At the end of this webinar, we'll also leave some time for questions and answers. So with more than 40% of its adult population already having received the vaccine, the US is beginning to open. Unlike the sprint down to the bottom when nationwide occupancies and revenue plummeted, we believe the turn back up will be more like a marathon that will take time, and we'll see a decent turnaround in the hotel market this year led by leisure travel. But the pace and the strength of the rebound will be location specific. To illustrate our view, we evaluated 6 hotel markets, each with a different landscape. Orlando and Austin had the strongest drivers and were firing on all cylinders before the pandemic, and will likely bounce back more quickly. Hawaii and New York City, both icons for leisure and tourism, will come back, but likely will take longer because of their unique characteristics. While pandemic weakness in Houston and Chicago comes on the heels of oversupply and falling demand, which will hamper their ability to return to normal this year. Suffice to say that we uncovered some surprising insights that make each market unique, even 2 markets in the same state that have vastly different outlooks. So with that, we'll get into the markets, and we'll first with Houston. Zavin, Houston was seeing some problems before the COVID pandemic. Can you tell us a bit about the landscape there?
Hi, Steve. Great to be here. One of the things about Houston is that as much as the economy has started to diversify away from energy, the sector still has an outsized impact on the area. There were more than 4,600 energy companies based there, and nearly a third of the country's employment in oil and gas extraction is in the Houston area. So there's a strong dependence on the price of oil. Since 2014, when oil topped $100 a barrel, petroleum has been on a pretty wild ride, with prices dropping as low as $27 a barrel. And as this happened, a large number of small and medium firms in the industry started pulling up stakes, and oilfield servicer companies also pulled back. Even as the price has stabilized to some extent, around $60 a barrel, it still isn't at a level where there's going to be a significant amount of new hiring or formation of new businesses. The weakness of the sector, coming on the heels of a sustained level of high price, means that hotels built in Houston during the run-up in prices might struggle to find demand. And all of this was happening before COVID hit.
So Zavin, the pandemic and the slowdown in travel came at a time when Houston really couldn't afford another hit in demand?
Exactly, that's right. Houston still creates a lot of new jobs every year, and over time, some properties could have started to stabilize. But overnight, hotels went from weak demand to no demand, and borrowers now faced a completely uncertain future. One thing to remember was that in some cases, the property values were already distressed. They might have been willing to hold on for a month or two, but the downturn was so sustained that borrowers might not have been willing to keep funding shortfalls. At the end, while they were staring at a tougher refinancing where in some cases they might have had to come out of pocket to close a new loan. So in our mind, it was inevitable that some of these borrowers would have little choice but to default.
So that's really interesting. And kind of keeping it in Texas and taking a look at Austin's market, which seems to be on a different footing than Houston's. Austin, turning it to Nan, Austin was one of the fastest growing cities in the country before the pandemic. Nan, can you describe the factors that were contributing to this growth?
Thanks, Steve. Good to be here. So the faster growth of Austin can be summarized to 2 drivers. The first driver is the business driver. Due to its tax advantage, entrepreneur ecosystem, technology, and innovation, Austin has become one of the top choice for corporate relocation and expansion. And so especially for those global tech giants like Apple, Facebook, Tesla. So the the state of Texas has been rewarded the Governor's Cup by the Site Selection magazine for leading the U.S. in capital investment for 2020. The basic expansion leads to worker relocation from those mega cities like Los Angeles, San Francisco, and New York City, and faster population growth contribute to the booming of the local economy. And the second driver is leisure driver. Austin's warm weather, laid-back lifestyle, and multiple big annual events attract millions of leisure travelers to Austin. It's not only contribute to the local economy, but also put Austin on a global map. The two well-known established music festival, one is Austin City Limits, the other is South by Southwest Music Festival, had over 860,000 attendants combined in 2019. So those leisure travel has a big impact on the local economy as well.
Yeah, so it seems like Austin has more diverse drivers than Houston for sure. Okay, staying in the South and looking at Orlando. Chris, prior to the pandemic, Orlando was trending upwards. Can you explain why the market was doing so well?
Yeah, thanks for having me, Steve. Basically, through the beginning of 2020, Orlando, kind of, I think, as you mentioned early on, was firing on all cylinders. For example, with Orlando International Airport, it had recently surpassed Miami International for the largest number of passenger volume in the state of Florida. This is both international and domestic travelers, and those numbers were growing every year. This kind of is an example of this increased interest in the area, which led to an increased demand and consequently an increase in supply for corporate and resort style vacation hotels in the area. And even despite this increase in supply, the hotel industry continued to either match or beat a lot of national averages for common hoteling metrics like occupancy, average daily rate, RevPAR, things like that. So all in all, with tourism being such a main factor and economic driver for Orlando, and travelers coming to the area in ever growing numbers each year, Orlando did look really healthy pre-pandemic.
Yeah, for sure. And Orlando is definitely heavily dependent on tourists. So as a follow-up, staying with Orlando for a second, what are the main factors to consider when evaluating the health of the Orlando economy?
Yeah, sure. The main factors, hands down, in Orlando are definitely the level of business and corporate travel to the area. The city is home to, as most people know, two of the world's most famous, largest theme parks, Disney World and Universal Studios Orlando. So a huge portion of the travel to the region does stem from people visiting and tourists coming to the area. So consequently, much of this hotel traffic comes from accommodating these travelers. And this can really sort of be seen, for example, in Disney World's own hotels and their own resorts, which account for 16.5% of hotels and 27,000 plus rooms in the area alone. And all of this kind of leads to the point that any analysis of the health of the Orlando market, the Orlando economy, really has to consider the attraction that these two parks have on tourists to the area. So that's one of the factors. And then the other main factor is corporate travel, as I mentioned. So Orange County Convention Center, which is located downtown Orlando, is the second largest convention center behind Chicago. It attracts over 1.5 million attendees each year, at least prior to COVID. And it generated almost $3 billion a year in positive economic impact to the local economy each year. And all of this kind of underscores just the incredibly large effect that business travel has on the area, aside from all the theme park attractions and the tourist attractions that bring in visitors to the area as well.
Yeah, those are some interesting stats. One quick follow-up question relative to Orlando's relative performance. Why do you think it has outperformed many other areas around the country?
Yeah, it's difficult to like accurately predict or say why it fared better, but there are a couple of differences between Orlando and a lot of other major high-profile cities in the U.S. The first sort of factor is it's similar to Austin. It's a warm, temperate climate that attracts, a lot of vacation goers every year. Obviously, travel has not been at the same level that it was pre-COVID, but the area has still benefited from this factor of people wanting to get out and be outside and be somewhere warm. And then the second difference is just the fact that Florida has been more lax in regulation throughout the entirety of the pandemic. This has allowed, Disney World and Universal Studios to reopen, albeit with limited capacity, but they have been able to reopen and they haven't closed since. I was actually in Florida a couple weeks ago, being safe, and it was like there was no pandemic. There was tons of people there, and things were open, and yeah, it was definitely something to see. And then in terms of just hotels, the main factor to note, the industry was growing and it was healthy going into the pandemic. So unlike a city that was maybe not doing so well economically, and then saw its struggles, accelerated by businesses closing and travel ceasing, Orlando really hasn't experienced this too bad. The hospitality industry, it's definitely been impacted. Those hoteling metrics like occupancy and ADR and RevPAR, those did get significantly affected. They dropped. But overall, hotels in the region have fared pretty well. And the main point, reasoning behind this is, like I said, the hotels weren't really struggling before the pandemic. And so they didn't get impacted quite as bad. And just one other point to make, there were 0 loans in special servicing and 0 loans that were delinquent pre-pandemic. So this is just sort of evidence of the health of the market prior to COVID.
Great insight, thanks. Okay, turning to the Big Apple. Masha, can you give us an overview of the state of the hotel New York market?
Hi, thanks, Steve. I'm excited to be here. Yeah, absolutely. Well, Steve, I think it's fair to say that the hotel market in New York City has never been this dire. Just for some context, in 2019, New York attracted 67 million visitors, 13.5 million of which were international travelers. Hotel occupancy rates were often in the 85 to 90% range. While we don't have final numbers for 2020 yet, revenue from the New York Hotel Occupancy Tax, which we think is a good proxy for hotel stays, dropped 90% for the second quarter of 2020. While we can also look at airport traffic, which is another key measure, showed sharp declines across the board. For the year to date, as of November 2020, the Port Authority of New York, New Jersey reported that the total passenger traffic was down 75.7%, with international travelers down 83.1%. In comparison to 2008, as the Great Recession took hold, passenger traffic to the 5 New York airport traffic was down just 2.7%. So it's fair to say that this is an unprecedented fall off in tourism. And since the shutdown and travel restrictions were put in place, 10% of the 127,810 hotel rooms in New York have closed permanently.
Wow, that really gives you an indication of the effect on the New York City market. Just real quick, so since the pandemic, what's happened to CMBS loans backed by hotels in New York?
Yeah, well, if we look at the total picture, there are 39 hotels totaling $1.9 billion in CMBS. More than half of those loans are specially serviced, and most of those loans are working under some form of relief granted by the special servicers, but a few others may be headed for foreclosure, unfortunately.
Mm-hmm. Yep, we're definitely seeing an increase in relief and modifications as servicers and the industry tries to wait out the pandemic. Okay, switching to Chicago. Alex, can you give us an overview of the Chicago hotel market and the major factors that drive it?
Sure. Thanks for having me on, Steve. So I think like a quick way to describe the Chicago hotel market would just be very saturated. Definitely a lot of hotels for an MSA of this size. So there's 140 hotels just like in the downtown area. So that doesn't even account for what else is considered the Chicago MSA, such as the suburbs. So just in the downtown, you have 140 hotels totaling 45 million rooms, which alone is a top 5 figure in the United States. This, massive number of hotel rooms is largely driven by the city's large number of tourists. Chicago remains, a desirable tourist destination, both internationally and domestically. So prior to the pandemic, so 2019, Chicago had 55 million tourists, which was good for 3rd in the country. And these tourists, can really fall into 2 major factors that drive the hotel market, which is leisure travel and business travel. Business travel in Chicago is mainly centered around business conventions, so group business travel, with the major draw being McCormick Place. As I think Chris brought up earlier, it's the largest convention center in the United States, brought in roughly 3 million tourists annually prior to 2020, was responsible for billions of dollars in economic prosperity to the city. Leisure travel, on the other hand, is a little bit less defined. Tourists can come for a host of cultural activities, museums, could be sightseeing like Navy Pier or events like Wrigley Field. But I would classify leisure and business travel as like the major drivers for the market.
Gotcha. So with those major drivers kind of being on hold for a long time, can you describe what kind of happened in the CMBS market in Chicago?
Yeah, for sure. And you definitely said it correct. Like with leisure travel and business travel being all but non-existent in the current climate, the CMBS market is definitely very tenuous right now. Most of the hotels in the MSA are facing an unprecedented financial pressure. Most of these hotels were performing at least admirably prior to the pandemic, so this is something new for them. With Chicago having very tight restrictions, and particularly over the winter months, such as banning indoor dining, most of these hotels saw record low occupancy. I did see like individual months where any given hotel could have occupancy sub 15%. So within the overall market, there's 19 CMBS loans in Chicago. Of these 19 loans, 11 were transferred to the special servicer. So that's about 60% of the total loans in the area. So of the remaining loans, there's about 29% that are currently performing and 10% that are listed as delinquent. And I would say that, the major point to highlight is that the nationwide special servicing rate, hovers right around 25%. And Chicago's reporting a figure of just about 60. So the hotels in the Chicago market are definitely facing, some difficulties as of right now.
Yeah, that definitely paints a cautious picture for sure. Okay, switching over to Hawaii, Ramir, definitely a unique market and has unique challenges. It's it's a fly-to destination. People normally think of it as a major leisure travel spot. Can you give us your overview of the state of the market?
Yeah, hi everyone. Thanks for the question, Steve. Really happy to be here. And like you correctly mentioned, Hawaii does possess a unique challenge compared to the other markets that we've seen, especially given the fact that the state itself is a fly-to destination for a lot of leisure travelers. So in 2019, the tourism accounted for 21% of the state's economy, bringing in nearly $18 billion, majority of which came from nearly 10 million air travelers that we saw in the state. In 2020, the same air travel measure went down by 74%. That resulted in an hotel occupancy of 25.3%, which was a 70% decline from the previous year. So that really shows us that, how much of an impact air travel and restricted, leisure travel was impacting some of these states. So while we've seen pent up demand and swollen saving accounts from like the past year's quarantine, and they point to a surge in luxury travel over the next few months or so. Hawaii's return to pre-pandemic travel faces a lot of challenges, and a lot of that comes from the confusing and inconsistent testing and quarantine protocols that they have within the state. Like we mentioned, having the heavy dependence on air travel. And some of the countries such as Japan and even Canada, for that matter, have not opened their borders for travel to Hawaii as of now. So for this reason, many hotels and resorts have also limited their guest capacity, and they've increased their cleaning and safety protocols, which has constricted the amount of rooms that they have in Hawaii. So it's been really interesting to see how Hawaii has maintained its position in the past few months, but we are also looking forward to what's in store for us for the next few months.
Yeah, it's definitely been challenging for sure in Hawaii. Can you give us a quick overview of the CMBS market there?
Yeah, so the total CMBS hotel exposure for Hawaii is nearly $4.3 billion for among like the 25 securitized hotels, and those are split up between the SASB and the conduit loans that are there in the state. And with Hawaii being the second largest MSA in the SASB loan segment after Las Vegas, which is nearly a loan balance of $3.4 billion. It's backed simply by 8 properties. So that's a significant chunk of the SASB loans coming from a very few number of properties. And all SASB deals in Hawaii are current, and with nearly 60% of them on the watch list of the master servicers, as they're keeping a close eye on the potential cash flow concerns that are stemming from the pandemic. And as far as loans that have been struggling, only 4 loans with a combined loan balance of nearly $50 million were modified with forbearance agreements that postponed either their monthly debt service or permitted the borrowers to tap into their reserves to make monthly payments. So while the smaller properties in the conduit deals with lesser known sponsors are the ones that remain severely affected, SASB deals on the larger properties that we've had continue to maintain their strong positions in the market, such as the Ritz-Carlton and the Hilton Hawaiian Village in Honolulu, which are backed by some of the bigger sponsors like Blackstone or Hilton Worldwide Holdings. So pretty interesting to see, how the pandemic has impacted the loan sizes and the sponsors backing them as well.
Yeah, no, that's great insight. It's definitely interesting to see how the SASB loans are how they're performing a little bit differently than some of the smaller conduit loans. Okay, so we've covered an overview of each of the markets. Next, we want to do a quick rundown of some of the loans that investors might want to be keep on their radars and loans that we're particularly concerned with in each of those markets. So flipping back to Houston, Zavin, can you describe a couple of the major loans that investors might want to pay attention to?
Yeah, so the biggest loan in Houston that warrants attention is the Marriott Houston West Chase. This is a CMBS 1.0 loan in a 2007 deal that did not pay off at its original maturity date. The property is in the Houston Energy Corridor, which, as one can imagine, was not the place to be after the fall in oil prices. It was initially modified with a maturity extension in 2021, and then in late 2019, before the pandemic, the lender modified the loan again with another extension to 2023. So as we can see, there are already problems with this asset. And then once the COVID shutdowns took place, the borrower came back to the special servicer with a request for additional relief, and those discussions are currently underway. The most recent appraised value was $47.5 million, which is $22 million lower than the outstanding balance and could face additional declines in value going forward. This hotel handles primarily business travel, and that is a sector that could continue to struggle over the next year or so as companies decide whether to let their staff go out on the road. While we think that it's positive that the borrower is engaging in negotiations rather than just handing in the keys, we do wonder how much relief the servicer can provide after 2 extensions. If the borrower is willing to invest in the property, though, there could be a more positive outcome.
Yeah, definitely. Extensions are the name of the game for sure in some of these properties. Have any other hotels seen a big value change?
So far, not yet, but not all loans have had new values reported since COVID. Another loan that I think is worth mentioning is the Holiday Inn Houston Intercontinental. The loan is in the 2014 transaction, which would have been done when oil was flying high, but by 2017, the loan was in special servicing. New hotels were built around the airport, and as demand slid, the property faced threats on both sides of the equation. The servicer took back the property in foreclosure in 2018 and started working on a property improvement plan with the goal of selling the property in 2021. Given the state of the market in Houston, a 2021 sale might not necessarily happen unless the servicers decided that there really isn't much upside in the property value. The Houston Intercontinental Airport is one of the largest airports in the country and a major hub for United Airlines. As we can imagine, that much of the hotel's demand is generated by the airport, from flight crews to displaced passengers and small fly-in meetings. But with the downturn in tourism, it's likely that the sources of demand have evaporated. In fact, for the month of February 2021, when Texas was largely open for business, year-over-year passenger arrivals were down 59.9%. And in the international segment, traffic was down 70%. While we think it's possible that the disposition of the asset will be pushed back into 2022 and beyond, where the servicer assesses the sale market for the property.
Okay, thank you so much. Let's see, turning to Austin, Nan. Any hotels you've got on your radar?
Yeah, so in Austin, there are two hotels that I like to mention. The first one is Fairmont Austin. It is the largest hotel in Austin metropolitan area and backed by $300 million in debt. It is located right across the street from the Austin Convention Center. Even before the pandemic, 70% of its revenue, its 2019 revenue, came from group and convention business. And because of the cancellation of the events and the hotel was closed from March to May 2020, then it was transferred to special servicing. After a series of cost-saving strategy and the implementation of high standard cleanliness, the hotel was able to reopen and back to current now. The second one I'd like to mention is in Austin is Regency Austin. Just like Fairmont Austin, it has great location, only a few blocks away from the Austin Convention Center, and its major revenue also came from the group and the convention business. The 103 million loans was transferred to special servicing for imminent default in August 2020 because of the property couldn't afford its operation. But the good news is that recently the property was acquired by Host Hotel Resort for roughly 161 million because the CEO saw its potential as the travel resumes. And the purchase is comfortable above the outstanding loan balance and just 3.6 million less than the reappraised value of 164 as of November 2020. So we believe that as more and more people get fully vaccinated in the summer and feel safer to travel, those well-located hotels like Hyatt Regency and Fairmont Austin are expected to benefit from the strong demand of the leisure and business travel.
Yeah, it's definitely a positive sign, seeing the hotel trade hands at well above the loan balance. Okay, thanks for that update. Turning to Orlando, Chris, any major loans that investors need to pay attention to? Any that may have been recently reappraised? Any large value changes?
Yeah. So in Orlando, as I mentioned kind of briefly before, there's no CMBS, or there are no CMBS loans that were specially serviced or were delinquent before the COVID-19 pandemic. This definitely lends to the argument that the CMBS market was relatively healthy prior to the pandemic. So, but nonetheless, numerous loans were transferred to special or became delinquent during 2020. So, two loans that we think are worth mentioning due to those reappraised values, as you mentioned, and those reappraised values then ended up lowering LTVs, obviously. So those two loans are the Marriott Downtown Orlando and Celebration Suites. So with the Marriott Downtown Orlando, this is a conduit loan that transferred to special during the pandemic. It fell delinquent in April 2020 and then was sent to special in July of 2020. Prior to all of this happening, it had been performing well. but this delinquency has since led to a reappraised value of $42.8 million. This is down about 50 million from 57.8 that it was at issuance. So this low appraisal obviously has increased the loan to value ratio to around 85%, up from around 65%. So it's not ideal, but it's not something that we're too concerned about, just when thinking about the fact that there's a lot of markets where there's loans that are at LTVs of over 100% now. So it's not as bad as it could be. And then the second loan that I mentioned was Celebration Suites. This one also transferred to special during 2020 for payment default, and the value was lowered from around $52 million at issuance to $33.5 million. This is about an $18 million decrease, causing the LTV to rise to about 76%, up from about 50. So as with the Marriott, obviously not ideal. Don't want to see that LTV rise, but the property value is still well above the balance of the loan. And actually, in February, the loan did return to the master servicer, so it is definitely on the right track.
Yeah, definitely, for sure. Those LTVs kind of staying out of the red zone of above 100%, and that's, while they, based on recent appraisals, hopefully things will improve as more people start traveling. That might also be an indication of more conservative underwriting when these deals were first issued. So thanks for that update. New York City, going back up to the Northeast. Masha, can you discuss some of the major hotel loans that investors should be concerned with?
Absolutely. First, I think it's worth talking about the New York Hospitality Portfolio Loan. This has a balance of $300 million. The loan is actually backed by 7 properties in the city, most of which are limited service. It has 1,087 keys that are scattered across several major areas, including Times Square, the Financial District, Chelsea, and Herald Square. The loan was transferred to the special servicer in April of last year, right after the reality of the shutdowns became clear, and its pre-pandemic performance had not been strong. In fact, its 2019 net cash flow was down 13.1% from the prior year.
Right, so its performance had been down a little bit, and I heard we recently received some updated information regarding the loan.
Yeah, well, originally the servicer had filed for foreclosure, but held off while the borrower negotiated a discounted payoff of the loan. In March of 2020, the mezzanine lender took over the properties from the borrower. This now gives the mezz lender the right to negotiate with the servicer. While on one hand, we think that is positive that the loan is not headed straight to foreclosure, there may still be negotiation for workout. But on the other, the one other thing is that I should say about this particular loan is that because the hotel are primarily limited service, they're going to cater towards tourists than business and convention travelers. And we think that leisure is going to be the first segment to start to recover in the US, although more in the domestic segment since travel restrictions are still in place globally. So it's possible that revenue here could start to turn around a little bit faster than at the other property. Still, it's hard to predict how quickly demand is going to come back. So it's still an open question whether or not a workout will have an impact on the bondholders.
Right, yep, understood that. Any other loans out there you'd like to highlight?
Yeah, another one we can talk about is the Soho Tribeca Grand Hotel Portfolio. It's another large loan. It has a balance of $225 million across 3 CMBS conduit deals. This loan is backed by 2 boutique hotels, the Soho Grand and the Tribeca Grand. The location of these hotels is strong because both neighborhoods Soho and Tribeca are very trendy and benefit from special events like New York Fashion Week and the Tribeca Film Festival. And the loan never transferred to special servicing, but in December, the servicer's comments noted rather ominously that the borrower was no longer interested in carrying the property and actually wanted to turn over the keys. However, just last month, the servicer reported that the borrower was again engaging in negotiation for forbearance. Throughout the entire pandemic, the borrower has continued paying on the loan, so we know that they have demonstrated willingness to fund the losses. So it's possible to say that there was some brinksmanship going on behind the scenes. We are cautiously optimistic that something can get worked out there that avoids a negative outcome. And again, this is a loan that has a good base of leisure demand. So we might see the beginning of a recovery at a high quality property like this.
Okay, interesting. So kind of want to get your sense of what you're seeing in over the broad spectrum of CMBS exposure to New York City hotels in terms of updated property values, because New York City obviously is probably top of mind for most investors.
Yeah, absolutely. So the two loans that I just discussed, there hasn't been a new appraisal, but several hotels have seen new appraisals. And the news isn't very good. Valuations for most of the COVID affected properties have fallen by about 20% to 54%. An example of one is the Standard Highline hotel loan is one we've seen a change in the value of about 29% or $99 million lower. We do think that there's a reason to be optimistic about this because about half of its revenue comes from food and beverage, and the property has upscale restaurants, including the top of the Standard, its rooftop lounge. And as the city allows restaurants and bars to reopen, we could see revenues begin to improve since it may benefit from local customers looking to finally get out of their homes. Another property that has had a an updated valuation is the Trip by Wyndham Times Square South. And it's another loan that has seen a large change in value, about 54% lower, a $46.9 million drop. This loan is delinquent and is backed by a limited service hotel. Its location could be a challenge too, as it's on 35th Street between 8th and 9th Avenue and is not as favorable compared to other hotels closer to Times Square, which attracts a lot of tourists.
Right. Those are some great highlights. And, you know, as you mentioned, location, even within New York City, still plays a key role. Okay, next, turning to Chicago. Alex, can you highlight some loans that you've got on your radar?
For sure. So I would say within Chicago, there's definitely two loans that stick out as being, you know, something an investor would be really concerned with. Starting first is the Palmer House. So this is actually was the longest continually operating hotel in North America. Original opening of the hotel was actually back in the 1800s. So, you know, you have just over 120 years of continuous performance, you know, for the hotel, but it has been on and off actually being closed and reopening. I actually believe right now it's still continued to be closed. But so this is actually the largest CMBS loan in all of Chicago. It has a balance just north of $325 million, so represents a massive portion of the entire CMBS market. But the hotel was actually just recently reappraised at under $275 million, which has created an updated LTV of right around 120%. So definite loss in property value, you know, for this hotel. And, you know, despite this, you know, long-standing performance, you know, longest, you know, property, like I mentioned, in the United States, the borrower has already stated an intention to foreclose. There was no updated budgets, you know, for the 2021 year provided, you know, by the hotel. You know, all indications are that, you know, the property is planning on being closed moving forward. Oh, sorry.
Sorry, go ahead.
I was going to say another loan, that I would definitely say would be worth mentioning is the Hilton Garden Inn. So basically the complete flip side of the Palmer House. This is a brand new hotel, just opened in 2015 and was a really strong performer prior to the pandemic. So 2019 cash flow on the property was about 7% higher than at issuance, signaling really strong performance. But during the pandemic, this actually had one of the worst occupancies in the MSA. It got as low in November of just 14% of total rooms were actually booked, which was among the lowest in all of Chicago. The borrower actually requested a forbearance on the loan, which was denied, and borrower has not yet provided an updated, status of the property moving forward, but there has been discussions about closing the hotel moving forward. So kind of shows that, even a recently opened property, with strong prior performance was, sort of immune to this climate. The borrower had to request forbearance, denied, and, now they're looking into potentially even closing this hotel.
Yeah, those two properties are definitely ones to keep an eye on for sure. In terms of, we've seen a decent number of collateral properties that have seen their values change since the pandemic based on updated appraisals. What are you seeing in terms of value changes?
Sure. So I would actually say this is pretty surprising considering, all the news about, the current climate in Chicago, obviously the global pandemic, but in terms of a large change of value, there was nothing, too surprising. I would say that, the largest change in value is definitely the Palmer House, which we already discussed, $50 million change in value, from the balance and updated LTV of 120. But even referencing, the 10 loan table that I placed on, my paper, 9 of those loans had appraisals in calendar year 2020. So definitely what you could consider like a recent reappraisal. But, so 9 out of the 10 with recent reappraisals, and there's only one other hotel with a current LTV greater than 100%. So most of the hotels in the MSA actually held their value pretty admirably, all things considered. So despite the reappraisals that occurred on most hotels, not many saw an actual loss in value.
Well, that's actually really good news. Okay, turning to Hawaii, Ramir. Can you give us what you see on your radar? Maybe like some in terms of SASB versus conduit. Any loans?
Yeah, for sure.
On your radar? Yep.
Yeah. So definitely, just to echo or like provide examples of what I said earlier on, I have 2 hotels that I wanted to talk about specifically. The first one being the Hilton Hawaiian Village in Waikiki, and the second one, which is a conduit loan property, which is the DoubleTree Grand Naniloa in Hilo. So the Hilton Hawaiian Village is a 22-acre property with nearly 3,000 rooms. And the property backs 9 pari passu loans with a combined loan balance of $1.28 billion, and nearly 60% of which is one single SASB loan of $750 million. So right off the bat, a pretty massive property in Hawaii itself. So although the loan sponsor is Hilton Worldwide Holdings, the property continues to be sensitive to the effects of the global economy. So while the property did display strong performance prior to the pandemic, the SASB loan may represent an elevated risk. So as the pandemic emerged, the loan's debt service coverage ratio dropped to 0.226 for 2020 because of sharp declines in revenue, food and beverage revenue, as well as any other departmental revenue that was coming into the hotel. And also, the occupancy for the hotel was down to 55% compared to its 93% numbers at issuance. So again, pretty significantly impacted as well. But as Hawaii reopens to domestic travelers, we do believe that the property will take a few years to recover completely from a year of little to no revenue, given the fact that Hawaii itself was pretty much closed from April through late October, early November. And the costs associated with the property's luxuries in terms of size, location, and services pose barriers to a quick recovery. So that's on the SASB front. And moving forward with the conduit loan, which was the DoubleTree Grand Naniloa in Hilo, this property makes up 3.6% of its conduit loan, and the hotel saw its value plummet 45% based on a November 2020 appraisal that we saw, and that time it was the borrower who defaulted and they requested relief. So we see, we're seeing the contrasting figures between the SASB property as well as the conduit loan itself. And the property, the DoubleTree was reappraised for 55 million, down from its original issuance value of $100 million. And this raised its LTV to nearly 90% compared to its 50% value at issuance. So, I think the important factor here to consider is, was the property doing well before the pandemic? And what we saw was the property was underperforming prior to the pandemic due to volcanic air pollution from the nearby volcano in 2018, which disrupted tourism on the east side of the island. And this is where the property is located. So just when the property started showing signs of improvement in early 2020, the pandemic totally halted its recovery as the loan got transferred to the special servicer back in June after the borrower fell delinquent. So the idea is, simple over here, that if a property was underperforming prior to the pandemic, and like it happened in Florida as well, if it was underperforming prior to the pandemic, it was just strained even further at the onset.
Sure. That's definitely, we see that playing out in many markets for sure. Okay, so that kind of takes us through the loan level discussions of each of the markets that we covered. Next I'm gonna ask each of you to give a quick conclusion, because we're getting close on time. A quick conclusion for each of your markets, kind of what you see going forward. Let's kind of go in reverse order. Since we just heard from Ramir, let's continue with Hawaii. What do you expect looking forward, Ramir?
Yeah, so quick conclusion. So over here, Hawaii, we do expect a long road to recovery for most Hawaiian US CMBS loans as tourism trickles back. And with tourism forecasted to pick up in the latter half of 2021, once more people get vaccinated and confidence to travel, to go on leisure trips increases, we believe that most loans will see an incline in performance metrics as 2021 unfolds. But one key thing to keep in mind is, as there are some loans that are maturing in 2021, they could face an increased refinance risk if investors do decide to pull back on lending under the sustained poor global economic conditions and continued travel restrictions for fly to destinations. So that's a key takeaway. And then we have the environmental perspective as well, where Hawaii's tropical location does create these low pressure systems and draws slow moving storms. And we did see some of these effects play back out in March earlier this year, where they did damage dozens of properties and which prompted evacuation orders from the islands of Maui and Oahu. So yeah, Hawaii is on its way to recovery, but it might take longer than expected.
That's great insight. Thanks, Ramir. Chicago, Alex, do you have any final thoughts you'd like to share?
Sure. So overall, I think that the Chicago market, in terms of its overall recovery, will lag most of the MSAs that we've talked about today. So I think over the course of the last year, the big driver is that it's really fair to question if business travel ever returns to pre-pandemic levels. I think between the hesitancy of employees to travel and the cost savings of employers sending people places, I think it's really going to be a long road to recovery for business travel. So that's definitely going to impact Chicago because, unlike a lot of these cities that may be more leisure-based, Chicago really relies on a, more or less 50-50 split on its travel. And, if business travel isn't coming back, Chicago is definitely going to be hindered. And in addition, Chicago does have leisure travel, but it's really relegated to a couple months. And that's just, based on the Chicago climate. As someone who lives in Chicago, I would not voluntarily take a leisure trip to Chicago in December. So most of the hotels in Chicago, record occupancy numbers, somewhere 15 to 25% higher in the summer months. And, with most of the, experts, predicting a return to normalcy, sometime around the late summer to potentially early fall, it's definitely very likely that Chicago misses out on its biggest draw for leisure travel, which could ultimately push its recovery back to 2022 as opposed to 2021.
Yeah, that's definitely makes sense for sure. Flipping to New York City, Masha, any final thoughts?
Yeah, absolutely. So as I mentioned earlier, we generally believe that tourism could start to recover a little bit quicker. And this is absolutely going to benefit from hotels that cater more to this demand segment. While business travel to New York could be definitely a little slow in coming back until the majority of companies start bringing employees back to the office, as well as employees start feeling comfortable flying again. And hotels that are popular with convention visitors could take even longer. The Javits Center, the largest convention center in New York City, is being used as a vaccination center for the foreseeable future. And it's going to be hard to book conventions at the center until that situation normalizes. So it could be a couple of years. The good news is that New York remains one of the biggest tourist attractions in the US. It may take some time, but over time, world-class cities like New York will continue to generate demand. If hotel owners can buy some time through negotiation, I believe a tourism recovery can help hotel cash flows recover.
Great. And next, Orlando. Chris, any final thoughts?
Yeah, just in the interest of time, I'll keep it quick. But the main, factors, as I've kind of said over and over again, are just, when will Disney World and when will Universal Studios return to pre-COVID occupancy levels, or capacity levels, I should say. Right now, they're at both are at about 35%. So, and they don't have any timeline for when they will be back to normal. And then the other factor, again, is corporate travel. And this one's a little bit more difficult to predict. But basically, when will corporations and when will consumers feel comfortable going to large gatherings and having face-to-face close interactions? So both of these things, like I said, are tough to predict. But, we can assume that, as vaccine rollout continues and as regulations loosen and, we maybe inch closer to herd immunity, capacity and also corporate and business travel should increase in stages.
Thanks, Chris. Austin, none. Texas Governor Greg Abbott recently allowed businesses to open at full capacity. Do you anticipate a quicker recovery because of that?
Yeah, so yes, so as the vaccine becomes widely available, we do anticipate Austin's hospitality industry has a quicker recovery and benefit from the pent-up travel demand. In fact, Austin already seen a sign of leisure travel rebound thanks to the rollout of the vaccine. For example, the well-known music festival I mentioned above, Austin City Limits, is scheduled to return for in-person gathering in October 2021. And its return will definitely offer a much needed boom for the local hotel industry and exemplify the optimism for the leisure travel. And in the short term, we definitely expect more from leisure travel rebound than the business travel. Business travel definitely takes longer to regain steam. But when it happens, Austin's hospitality sectors will definitely speed up its recovery to 2019 level.
Thanks, Nan. And lastly, Zavin, any other thoughts you'd like to share?
Yeah, so real quick, just on Houston. Well, Houston is fairly unusual in that the hotel sector really struggled prior to COVID. But the one bright spot in the market might be properties like the Hampton Inn and Suites Medical Center. The Texas Medical Center has been this area where Houston's really diversified away from energy. We see 8 medical schools, 21 different hospitals there, and over 100,000 employees and visiting academics and professionals. So while shutdowns might have hurt it in the short term, this is going to be an industry where there's going to be demand over time because research can't be conducted over Zoom. And people are going to still need to visit in their families for treatments and things like that. So we could see a rebound in demand there. And this area could also cater to things such as like the Houston Rodeo just to the south of it. So it is a bright spot for Houston there.
Yeah, it's interesting that Houston has definitely tried to diversify itself over the past 10 years, and hopefully that'll pay off. With the few minutes we have left, I'm going to turn it over to real quick to Dave Putro, Senior Vice President in our surveillance area, give a brief overview of what he's seen in hotels. Dave?
Thanks, Steve. I'll take advantage of this time. First, we did have one question come in about the performance of the Disney parks, and just some real quick numbers for quarter over quarter, so end of fiscal year 2019 to end of fiscal year 2020, fourth quarter of each year, domestic revenue was down about 70%. Now, this also includes the way that Disney classifies. It also includes their cruise operations, but still a pretty significant hit on the parks and experiences as they classify it. And then I guess a little less precise, some information that's geared more towards visitors trying to pick ideal times to go shows that foot traffic at the end of the third quarter was still down 58% at Disney in Florida. So, these numbers are a bit dated. I know Florida's opened up a bit since then, but based on Disney's last SEC filing, there was a 70% reduction in revenue fourth quarter over fourth quarter. So I will now rapidly run through a couple of notes on what we're seeing or have seen in surveillance. Obviously, last year, at this time, our biggest concern was hotel. Cash flows had instantly shut off, and we were kind of cautiously awaiting what the next step was. I think one of the things that surprised us on the surveillance side was the speed and the volume of forbearances getting done on hotels. It seemed like any loan where the borrower and servicer could find any kind of common ground resulted in a very quick forbearance being booked. And typically these were 3 to 6 month P&I forbearances, loosening up the use of reserves, maybe waiving some debt service covenants, whatever the case was, with anything deferred to be repaid over the following 12 months. And while this was good for short-term delinquency, it does make it difficult to track performance through the usual trends of delinquency numbers and special servicing transfers. So we've been kind of watching all along that there's a shadow delinquency that's hidden in some of these numbers. And it's going to be interesting now that economies are opening back up, and some of these forbearances are burning off. It's almost a race against time. You have borrowers who are now obligated to pay debt service plus 1/12 to make up what was missed, or 1/6 whatever was missed last year, versus uncertainty as to how quickly that cash was going to rebound. So we've started to see a handful of loans where borrowers have come back for a second relief request. I would say not enough to be a trend yet, but it'll be interesting to see how that plays out over the next few months. On the appraisal side, I think obviously retail reappraisals have gotten the headlines, and while the hotels we've seen come through have not seen the haircuts relative to issuance values the same way that retail has. I mean, they still have been significant. I think the one difference that we've noted, and it's hard to quantify again given how servicer data comes through, but having access to actual appraisals at times, where we do see a stabilized value being presented, that delta between as is and as stabilized on the hotel side tends to be more favorable than what we're seeing on the retail side. And in some cases, seeing as stabilized values that exceed the issuance values, which is all good news. I guess the downside to that is some of the stabilization periods are pretty lengthy. So we're seeing these rebounds being projected by appraisers that go out to 2024, 2025. So I think, on a relative basis, there's some sentiment that the property is going to bounce back. It might take a bit of time. And obviously, anything maturing in the interim, it's going to be very interesting to see how they pay off or how they manage around the maturities, whether that's extensions or or some additional relief. So that's what we're being mindful of now. And then just a couple other quick notes. We're over time, so I'll make it very, very brief. But I think as some of the panelists noted earlier, there have been some asset sales which have come in, either in excess of loan amounts or in excess of most recently reported appraised values. I think there was an Austin property that was mentioned earlier. There was one in Nashville, and these are sizable properties. So that's been a plus. And we've also seen, I guess, an increase in mezzanine lender foreclosures. Masha mentioned the New York hospitality portfolio. I'm probably the only nerd in the country who scours the CMA every week to read the UCC foreclosure filing notices to try to see if they're Cmbs backed and what they're related to. And there definitely has been an increase, having gone through the last downturn kind of on the other side of the table. I can tell just anecdotally that mezz activity has been, or mezz lender foreclosure activity has been much greater than the last downturn. So, again, not knowing if that's going to result in some additional workout negotiations with the servicer. There have been some cases where, I think it's undoubtedly a positive to the trust that we're looking at. You have hotels that were sort of running short on PIP dollars or something like that, where a mezz lender can come in for a very small investment, a couple $1 million to finish the PIP and take a property in a pretty good market that was performing very well pre-pandemic. That's been a positive so far. So we're 2 minutes over now, and I ran through that very quickly. So I will bow out.
No, appreciate it. That's really good stuff, and it kind of points to the direction that the market is likely headed. Kind of hits on my closing thoughts as well. Although we've seen some value declines, it hasn't been the bloodbath that we feared at the beginning. So far, pandemic-related income problems haven't led to massive distressed sales. But you have to frame that against the fact that, lack of distressed sales is kind of framed against all the loan modifications that you spoke of, right? Lenders have been open to forbearance modifications, which is likely why, and you mentioned this as well, why this special servicing rate remains elevated, but the delinquency rate has actually fallen. Special servicing rate as of March was 24.3% for hotels, and the delinquency rate was 15.8%, down from 23.9% from the same period in 2020. So that kind of paints that picture. So just one closing thought, that the prospect of the recovery is visible, and it will be telling what happens this month when a sizable number of loans that have forbearance periods that you mentioned end, and we'll see what happens when that happens. So with that, we'll wrap it up. And I just wanted to thank everybody for participating today. You all gave great insight, and we hope everybody got some good takeaways. So we will see you in 2 weeks for our next webinar.